Right now, the euro is doing something that will trap 90% of retail traders. It's bouncing while the daily chart screams strong sell. The dollar just slipped from a 2-month high on Iran headlines, and I'm seeing a flood of early longs piling into euro to US dollar thinking this is the reversal. It is not. There is one danger zone and one hidden opportunity right now. I'll show you both. If you're long here, you are standing on a trapdoor. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow, complete with stops, targets, and the one invalidation level that says the trap has failed. My session bias for euro to US dollar right now is this, fading the bounce aggressively. Trend-wise, we have a monthly by structure fire in the background, but the weekly is a fresh sell, the daily is strong sell, the 5-hour is sell, and the 1-hour is sell. That's a cascade of selling pressure with a single higher time frame tailwind that is fading fast. This is not a dip buying environment. This is a sell into strength environment. Write this number down. If we break above 1.1653 today and hold there on a 4-hour close, the entire bearish structure resets. That is the invalidation level for every short idea I'm about to give you. Here's the micro insight. The herd is positioned for a continuation of this dollar dip because Iran talks are supposedly easing tensions, but open interest data shows late longs piled in just below 1.1630. The market loves to run stops, and those stops are sitting right above 1.1670 and right below 1.1590. That's the liquidity pool we are targeting. Let's zoom out and walk down the charts. On the weekly, the euro has decisively lost the 20-week moving average, which currently comes in near 1.1750. More importantly, the 200-week moving average is sitting down here at 1.1220, and the price path of least resistance is a grind toward that magnet, not a sudden surge higher. The weekly MACD has a fresh bearish crossover, and the signal line is accelerating lower. This is momentum that doesn't reverse in one session. Drop to the daily. The daily chart is a strong sell, and the moving averages tell the whole story. The 200-day moving average is right at 1.1592, almost exactly where price is hovering now. That's not a coincidence. It's a battleground. The 100-day MA is at 1.1674, the 50-day MA is at 1.1675, and the 20-day MA is at 1.1651. Those 3 averages are converging in a tight band between 1.1650 and 1.1675. That zone is a brick wall of dynamic resistance. As long as we are below that zone, every bounce is a selling opportunity. The RSI on the daily is 44 and rolling lower. There's no divergence to lean on, just steady decay. The MACD is negative, printing minus 0.001. But the histogram is extending below the signal line. This is a continuation signal, not exhaustion. Now the 4-hour chart. Here's what most traders miss. Price made a minor high around 1.1640 earlier this week, and since then, the 4-hour candles have been printing lower highs and lower lows. Look at this 4H negative momentum signal. The bull-bear indicator is at minus 0.0036, firmly in bear territory, and the stochastic is at 49, nowhere near oversold. That tells you there's still plenty of room to fall before we even get a reflex bounce. There is no positive divergence on the MACD. The histogram bars are making fresh troughs alongside price. This is textbook bearish structure. On the 1-hour, the moving averages are stacked in perfect bearish order. The 5-period MA at 1.1625 is below the 10 at 1.1633. Which is below the 20 at 1.1651. Price is below all of them. That's a short trigger cascade. When you see this across multiple timeframes, you don't fight it, you flow with it. And here's the crosser-set linkage. The euro is moving tick for tick with the German 2-year yield versus the US 2-year yield spread, which just widened again in favor of the dollar. That spread is pushing to new cycle wides, and euro to US dollar is following it down like a shadow. The correlation is tight. Money is flowing out of euro fixed income and into dollars, and the currency pair is reflecting that immediately. Let me give you the precise support and resistance levels you need to tattoo on your screen. Key resistance. 1.1631 is the first hurdle, then 1.1653, then 1.1671. Key support, 1.1591, then 1.1573, then 1.1551. The 200-day MA at 1.1592 aligns almost perfectly with that first support at 1.1591. That is the level to watch. A daily close below there opens the trapdoor. The next signal changes everything. Yesterday's price action was entirely about the Iran talks headline. The dollar slipped from a 2-month high because the market briefly priced in a geopolitical de-escalation that could reduce safe haven demand for the greenback. But look deeper. This is a textbook head fake. The euro didn't rally on its own merit. There was no positive European data. In fact, the ECB's rate path is being repriced lower as German manufacturing orders continue to disappoint. The policy divergence battle is widening, not shrinking. The Fed is holding rates higher for longer, and the ECB is being forced toward cuts by a stagnating economy. That yield differential is the euro's anchor around its neck. The bounce was a short covering reflex, nothing more, and those shorts will reload at higher prices. Meanwhile, the yen trading near 160 is adding another layer. Carry trades are alive and well, which means funding currencies like the euro under structural pressure. When traders borrow euro to fund high-yield bets and the dollar is the destination, euro to US dollar bleeds. Do not confuse a geopolitical headline with a trend change. My 1 to 2 week directional lean is firmly lower as long as we trade below 1.1653. The event that invalidates this view is a daily close above that level. Not a wick, not an intraday spike, a daily close. Do you think the dollar breaks 105 on the DXY this week? Comment yes or no right now. I'm tracking consensus across the channel. Most people skip this section. That's exactly where the money is made. Keep watching, because I'm about to lay out 3 distinct trade plans with exact entry triggers, stop losses, and targets. Write these down. Strategy 1, the sniper, conservative. This setup waits for the bounce to exhaust itself right into the moving average resistance wall. The trigger condition is a 1-hour candle close below 1.1631 after prices tag the 1.1650 to 1.1653 zone. You need a rejection wick on the 1-hour chart to confirm sellers are stepping in. The stop loss goes at 1.1675, which is above the 50-day and 100-day moving averages and above the recent swing high. The logic is simple. If the pair recaptures that supply zone, the bearish structure is broken, and we do not want to be short. Take profit 1 is 1.1591, right at the 200-day MA and first support. That gives you a risk-reward of roughly 1 to 2.8 on that first target alone. Take profit 2 is 1.1551, the next liquidity level below the range. If price achieves target 1, move your stop to entry and let the runner ride. This entire setup is void if the daily candle closes above 1.1653 at any point before entry. The sniper, conservative, entry. 1H closed below 1.1631 after rejection from 1.1650 to 1.1653 zone. Stop loss 1.1675. Take profit 1, 1.1591. Take profit 2, 1.1551. Risk reward 1:2.8R to TP1, 1:4.4R to TP2. Invalidation daily close above 1.1653. Strategy 2, the active trader, standard. This is a breakdown. Play, ideal if the price starts hovering around the 200-day MA and loses support. The entry condition is a 4-hour candle close below 1.1590. You need a decisive close, not a whipsaw candle with a long lower wick. Stop loss is placed at 1.1620, just above the current hourly resistance cluster. Reason: if the breakdown fails and price reclaims 1.1620, the market is likely to squeeze shorts back into the range. Take profit 1 is 1.1573, which is a minor support but often acts as a pivot. Take profit 2 is 1.1551. Once target 1 is hit, set a trailing stop of 15 pips to lock in gains. The risk reward on this trade is roughly 1 to 2.5 to target 1, and 1 to 4 to target 2. Type your euro to US dollar range for tomorrow in the comments right now. Let's see who's aligned with the breakdown scenario. The active trader, standard, entry, 4H candle close below 1.1590 stop loss, 1.1620 take profit 1, 1.1573 take profit 2, 1.1551 trailing stop, 15 pips after TP1 hit risk or reward, 1:2.5R to TP1 invalidation, 4H close back above 1.1620 strategy 3, the aggressor, high risk. This is a momentum chase entry for those who can act on fast 1-hour candle closes and accept a tighter stop. If the price prints a strong bearish 1-hour engulfing candle that closes below 1.1585, you enter short immediately. Stop loss goes at 1.1610, just above the prior 1-hour swing high. This is a counterbounce play. You're getting in before the crowd confirms the break. Take profit 1 is 1.1551. And take profit 2 is 1.1500, the psychological round number that often attracts stops. The risk here is that you get trapped by a fake breakdown. Only for those who can lose small and manage risk aggressively. This setup is invalidated if the very next 1-hour candle closes back above 1.1590. The aggressor, high risk, entry, 1H bearish engulfing close below 1.1585 stop loss, 1.1610 take profit 1, 1.1551 take profit 2, 1.1500 risk, reward, 1:1.7R to TP1, 1:4.3R to TP2 invalidation. Next 1H candle close back above 1.1590. Never risk more than 1 to 2% per trade. No positions through high-impact US dollar news or ECB speakers. Stops are non-negotiable. This is how you survive to trade the next big move. Preserve capital, and the opportunities will always be there. The single most critical level for the next session is 1.1590 to 1.1592, the 200-day moving average support. A daily close below that and the euro opens the door to 1.1550, then 1.1500, and beyond. A false break and reversal above 1.1630, however, is a painful short squeeze waiting to happen. Tomorrow, I'll be watching the German industrial production data and any further Iran headlines that could temporarily lift the euro, but the trend will reassert. The real wildcard is the bond market. If the US-German 2-year spread rips wider again, the trap springs with momentum. In the next video, I'm breaking down Bitcoin's huge divergence from the S&P 500 and why the liquidity grab is approaching a critical level. If you want that full breakdown, it's live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.